Just tell me how you're framing this for clients at the moment. What are you telling them?
I mean, look, clearly, as you say, escalation of events in the Gulf. But for us, I think the US is redefining their red lines. And we are clearly seeing Iran test some of those red lines. We need to see how that unfolds from here. But it's a very clear message from both sides, really, but particularly from the Iranian, that sanctions are crippling their economy. No two ways about that. But they're just not going to sit back and watch that happen.
Amrita, at the moment, it's a tug of war on the supply side. The supply risk goes both ways. A couple of weeks ago, we were talking about a supply glut weighing on crude, and now we're talking about tensions in the Middle East. What do you think is the more powerful force here over the coming months?
Well, look, I've always said this. I don't think there is a supply glut at all. I know, yes, US crude inventories have been building, but that's because we've had a lot of unplanned outages. The reality is we've drawn an enormous amount of oil on water. We've drawn about, 60 to 80 million barrels. And all the floating that you see now is Iranian stuff that can't be sold. So the market's tight, and that's why the market's backwardated. Any disruption right now, however small it is only going to get the physical market much, much tighter and provide an upside risk to prices.
So, Amrita, if the market is tighter than a lot of people appreciate, what does that mean for the OPEC members as they get together in the next month? What are they going to do?
I think the critical thing for the market and for OPEC now is demand. I think the reason prices even came off is because the entire focus was on the trade war, whether it be the Fed, the ECB. And I think OPEC are also extremely, extremely focused on that. All my recent meetings with them have basically said, look, the G20 is important. Let's see what the trade talks take us, because they are very worried that we could be going into a recession. If that's the case, the response has to be very, very different. Right now, if demand is okay, the risks are very much on supply is underperforming and prices can go higher. But they are still focused on demand. So we think there's going to be a rollover of the 1.2 million barrels per day cut.
So, Amrita, looking at demand right now, though, do you see any signs of real softness in the here and now? I know the perception is that demand could soften as the year grows older, but where are you seeing the demand weakness at the moment?
There is softness for sure. I think European numbers have been very weak, kind of coming in slightly down about 100,000 barrels per day year on year. China and the rest of Asia has been weaker as well. So again, it's not catastrophic. We're not talking about 1 million barrels per day of decline. You're talking about, say, 900,000 barrels per day of growth. But, remember, for the past 4 or 5 years, you've had 1.5 to 1.8 million barrels per day of growth. So it's a big step down. But yes, you're right. It's nothing catastrophic where it's very clear that, we are in a recession and demand is declining. It's a softening in growth.
So, Amrita, let's put some numbers on this. I caught up with Jeff Curry of Goldman a couple of weeks ago, and before this week's events, he was looking for crude to end basically where it is right now on Brent, in and around $65. What's the number you're looking for as the year progresses?
Look, as long as we are not in a recession and the market is as tight in the physical context as we've been saying, I think we will go back into the 70s, and 75 for Brent is what we would be looking at. But again, I caveat that with the demand side, and any further escalation on the geopolitical side, it could be a lot higher than that.
Amrita, always great to get your insight in the commodity market.